just returning from a very good meeting with one of my hedge fund colleagues, and we started to discuss this most recent market calamity we're seeing over the past week or so as the Brexit fears are really starting to take a hold of the markets. And while there's many ways to play all this fear, and Clubhouse members are very well informed on this, one theme that strikes us as pretty clear is to play all this via sort of more consumer-oriented stocks. And one of the very obvious names here in that space is Starbucks. We continue to think that Starbucks is something that should remain under pressure, just from the economic slowing perspective, and really the entire environment that we are in. So Starbucks is the trade that I'm going to look at today for you guys. So let's have a look at the charts.
All right, guys, so before we even look at the charts of Starbucks itself, we have to gain a little bit of perspective. For those of you guys that have followed me for the past months and years, you know that I always like to gain a little bit of perspective. So what we did here, very simply, guys, we simply made a ratio chart. We simply took the consumer discretionary ETF for sector of the S&P 500, divided it by the consumer staples. So what that looks like up here is the XLY divided by the XLP. And what you can see in relative terms, basically consumer discretionary stocks, or more sort of cyclically exposed stocks like a Starbucks, have been showing a lot of relative weakness ever since March, or actually April of this year. If we want to be a little bit more technical on this, you can see basically we've traced out a head and shoulders pattern that's got a very basic neckline here. Now, this is a little bit of perspective, I think, very, very important for people to keep in mind when we look at any discretionary stock here. Looking at Starbucks, you can see basically we have a stock that, even though it hasn't necessarily been pushing higher until just about April, this stock has more or less kind of been able to hold in there. What the problem has been is very much what I just showed you on that relative chart, is that Starbucks has been giving us a lot of weakness here over the past, let's call it a month and a half, almost 2 months at this point. So if we now look at our basic candlestick chart, or just our sort of regular chart, you can see what that looks like. We now have all the medium-term moving averages. We've got the 50, the 100 and 200-day moving average. You can see they were all kind of bunched together. They're starting to show separation and rolling down, i.e. rolling over. To give this a little bit of a cleaner look, what we're going to do very simply, and again, it's all about keeping things simple, guys. That's why why Clubhouse members really, really enjoy this service and make money, is because they can understand it. You can see we have a bunch of support here. So that's kind of the last area of support. If Starbucks break below 52, 53 bucks on a weekly closing basis, that would probably mean a bigger move to the downside is to come. But right now, we do have a concerning price, some concerning price action already, and that's basically the sort of tight trading range. So as soon as Starbucks starts, in this case, breaking below about 54 bucks at the latest, maybe 54.50 on a daily closing basis, we do think this stock can fairly quickly start moving into the lower 50s. As it continues to go lower, the stock has been reacting bad ever since earnings reports. You see it gap down here after earnings in April, then started slicing through its moving averages, and again, now the moving averages are rolling over. So there's no reason to overcomplicate this. Starbucks here does look like it wants to roll over to the downside, particularly if it drops below 54.50. We do think the low 50s are in play. So that's it for Starbucks here, guys.
That's it for today's vlog, guys. I hope this made sense. Please be sure to follow me on Instagram, instagram.com/steadytrader, for more tips and tricks.